Hello friends, I want to help you understand and answer the question, can short-term rental losses offset ordinary income? So can short-term rental losses actually offset ordinary income? Well, by the end of this video, you'll know how to leverage your short-term rental losses to offset ordinary income, potentially saving you thousands of dollars in taxes. This is crucial knowledge to help you maximize the profitability of your short-term rental. Have you ever wondered how short-term losses could potentially help offset your tax situation? Have you ever been curious about the IRS rules and how to navigate those? Well, stay tuned as we break down the essentials by first helping you understand what passive and non-passive losses are. Next, I will explain criteria for non-passive losses. And finally, I'll cover the benefits of non-passive losses as it pertains to short-term rentals. If you're ready, let's go. So what are passive and non-passive losses? First off, I think we got to understand what a loss is, specifically a capital loss. So let's dive into that really quick. There's such things as capital losses and capital gains. Now, understanding this is important, even just going to the basics. So let's say that you bought a property for $100,000, just to make the math easy. And let's say that 2 years later, you sold that property for $150,000. So you bought it for $100, you sold it for $150. The gain of what you bought it for and what you sold it for, that is the capital gain. So there's a capital gain of $50,000. And with capital gains, the government looks at that and says, okay, that's a capital gain. They've got to be taxed on that. But the neat thing about capital gains is it is taxed at 15 to 20% versus ordinary income that's typically taxed anywhere between, say, 28 to 40%, depending on how much money you make. Now, on the other side of that, you have a capital loss. Same thing. Let's say you bought a property for $100,000 and 2 years later, you sold it for $90,000. You've got a capital loss of $10,000. Now, that just typically goes on your taxes as a capital loss. There's definitely some benefit to putting a capital loss on there, but with short-term rentals that we're going to talk about here shortly, there's a potential way to have those losses not just offset capital gains, but maybe potentially offset ordinary income. So now that we understand capital gains, capital loss, let's dive into passive and non-passive losses. A passive loss can be claimed by a rental property owner, but passive losses can only go against passive gains. And a passive loss can be considered the loss from selling the property at less than what you bought it for, or it can be classified as expenses exceeding income. So if you had a property that maybe the gross revenue of that property was $60,000, but all expenses were $70,000, you're gonna have a $10,000 passive loss on that property because the expenses exceed the rents or the income coming in. And when it comes to the IRS, there are two types of passive activities. The first one is business or trade activities in which the taxpayer does not materially participate during the year. And then rental activities. And those are even those in which the taxpayer does materially participate, unless obviously the taxpayer is a real estate professional. So let's go through an example with a couple pieces of property. Let's say that you have a property that lost passively $5,000. Let's say that expenses were $10,000 more than income that came in. So you have a $10,000 passive loss on that property. Let's say that another property expenses were $50,000, but revenue is $55,000. So you had a $5,000 passive gain. So that passive gain offsets the passive loss, and that passive loss can be carried forward to the next year. That's another cool thing about the whole game of real estate and optimizing the benefit when it comes to taxes. So non-passive income includes the following: income such as wages, business income, or investment income. Non-passive losses include losses incurred by the active management in the business. Now, short-term rentals can be a great way to save money on taxes, but you have to understand the strategy. And I tell everybody, I'm not a CPA, I'm not a tax person. I can just give you enough information to be dangerous, but this is definitely something you want to take to your CPA. Matter of fact, as I was diving into this, I've been talking to our CPA exactly about this and the short-term rental loophole, and it actually opened his eyes because it was something that he had heard about and done a little bit more research in. So you understanding it, it's going to empower you to know to take it to the right people. So the goal with this is to make your short-term rental income non-passive. And short-term rentals are an awesome real estate strategy because of this dynamic. So how do you make your short-term rentals non-passive? So number one, you have to rent your properties for an average of 7 days or less. Now that doesn't mean that any stay can't be over 7 days, but on average, the average stay at your property has to be 7 days or less. So let's say you rent it out one time for 10 days, but most of the time on average you're doing 5 days. Chances are for most short-term rental properties, they're gonna fall under those 7 days. And the second one, and this one isn't one that I even like mentioning because it's a little bit more difficult. Most people already qualify by the first requirement, but this is allowing you to rent your property maybe as a midterm rental for longer than 30 days, but you have to offer substantial services in doing so. Essentially, you're running a hospitality business. And by substantial, trust me, I'm sure the IRS is going to dig deep into that. So it's just easier to qualify by the first step of renting it out on average 7 days or less. So by either one of those criteria, you qualify for non-passive income for your short-term rental. So to answer that question, can short-term rental losses offset ordinary income? The short answer is yes. By renting out your property on average of 7 days or less, you can qualify your short-term rental as non-passive income. But there are some common mistakes people make. The first one has to do with how you use the property personally. So if you're going to utilize your short-term rental, you can only stay there for the greater of less than 14 days or 10% of the total days rented, right? So if you rented it out for say 200 days, you can stay there whatever's greater, either 14 days or 10% of 200 days is 20 days. So that's how many days you could stay at your own short-term rental property. But you have to do either one of those two or else you don't qualify. Because staying more than that could be considered a residence, and that allows you to take away that non-passive status. The other mistake people make is defining a stay. A stay is actually somebody who is renting it out from you, not a friend who's staying there or a relative, but it has to be a paying person that is paying to stay there. Otherwise, it doesn't count as a rented day. And by falling short on one of those, you definitely risk the advantage of being non-passive income for your short-term rental. Now, as I mentioned, I am not a CPA, not a tax person. I just know enough to be dangerous and to help people get an idea of things they can do to benefit from owning a short-term rental. Now, I'd be interested in what your feedback is. What have you learned when it comes to short-term rentals to take advantage of some of these tax codes that are beneficial to short-term rentals? Please comment below. Let's engage in a dialogue. And as always, I've got a free gift for you. It's a short-term rental calculator. Put in all your income, all your expenses, and it spits out to you whether it's a good deal or not, and it's 100% free. All you have to do is click on the link below, aaronsfreetraining.com. Once again, thanks for stopping by. Have an amazing day.